How is everyone doing? Welcome to the Strategy Room. You are here with your host, Dr. Joe Berquist, the banker next door, on this Saturday night, February 14th, 2026. I thank everybody so much for joining me. I apologize. A little bit of a late start here tonight. I had kind of a, little Valentine's Day craziness, as it were. I'd say happy Valentine's Day to everyone out there. I hope everyone is having a good one. But yeah, got a lot of stuff in store tonight. We got a lot of stuff to talk about. We're going to kick off tonight talking a little bit about the national debt. We're going to look at interest rates. We're going to talk about inflation. We're going to talk about the jobs report. We're going to talk about job revisions. I got a whole bunch of Epstein news that just the fallout from Epstein is just really wild. So we got a lot of stuff affecting a lot of people in the banking and finance circles. So we're going to take a look at a lot of that later tonight. Let's see, what else do I got on tap here tonight? So, I'll talk about, I actually put out 6 episodes this week. So I'm going to talk about those episodes, give everybody a little update on that. I will give everybody all the typical information. We're going to be doing economic indicators. We're going to be doing typical banking news later on. A lot of really interesting bank stories for everyone tonight. We're going to be talking a little bit about CEO pay. I've got a couple, like 3 articles on 3 different high-profile bank CEOs, what they're being paid. Some people might find that a little interesting. And then I've got a little bit of tariff news for everybody. And we're, like I said, so we got a lot to roll into here. So let's get started here in a second. As I always like to do, I always like to show everybody this is the U.S. debt clock here. I always like to focus in on the top corner. So we are at $38.6 trillion in national debt. Debt per citizen, $112,765 per citizen, $355,000 per taxpayer. The U.S. federal budget spending a little over $7 trillion. The U.S. federal budget deficit still at a negative $1.7 trillion. Tariff revenue is up to $373 billion. That equates to $3,247 per taxpayer. The debt to GDP is at 124%. Now, I want you to keep that in mind because I'm going to show you an article here in just one second. And we're going to come back to that debt to GDP number because I'm going to show you something here in a second. So interest on the national debt creeping ever closer to $1 trillion at $989 billion. Credit card debt. That's kind of interesting. 43. That's got to be a mistake on there. Credit card debt is not 43 trillion dollars. Like, no, it's something's got to be. Am I looking at the wrong thing there? No, I got to be looking at the right. Okay, yeah, I think they've got credit card debt number a little off there for some reason. But anyway, all right. Well, we'll come back to this. So the first thing I wanted to do is I wanted to show everybody this article real quick because I thought this was kind of goes hand in hand with what we were just looking at there. The U.S. debt is set to crush the world is set to crush World War II record as annual deficit explodes to $3 trillion within a decade. So the budget watchdog projects debt held by public will climb to 120% of GDP by 2036, raising fears of a fiscal crisis. So think about that for a second. The budget watchdog predicts that debt held by the public will climb to 120% of GDP. Yet we are already at what I just showed you. The federal debt to GDP is already at 124%. So, for them to be freaking out over, the public debt could climb to 120% of GDP. Well, I got news for you. We're already on the federal debt. We're already at 124% debt to GDP. So we're already in a really bad way. But what this article goes to explain, and I think this chart is a good chart here, is that right now it's basically saying that the basically consumer debt to GDP is sitting at about 99% right now, but it is expected to, explode way up here to 175% at 2056. Now, when you look at the federal debt. The federal debt is, I mean, we're, like I said, I just showed you, we're at 38, we're $38 trillion right now. That is scheduled. If things do not change, we are scheduled to be well over $50 trillion in national debt within the next 10 years. I mean, it's gonna fly up there. I mean, we're basically adding $1 trillion to the national debt every 120 days. So approximately every 4 months, the national debt's going up another $1 trillion. So we're going to get up there. We're going to throw another $12 trillion on top of that national debt very, very quickly. So, but like I said, I just wanted to point this out to everybody because I thought it was really interesting to look at this from a, kind of the consumer perspective as opposed to the federal perspective, which is what we're always looking at here. So okay, but there's that. And so basically the debt situation, not good. Needs to get back under control real quick. So all right, let's take a look at interest rates here for just a minute. So we had a very interesting thing happen this week. I'm going to get to the jobs report in just a minute. So we had a in a sense, it was like a blowout jobs report because it was just, I don't personally consider it a blowout jobs report because I think, I'd like to start seeing job creation of 200, 250, 300,000 jobs a month. That to me is a really strong, robust blowout jobs report. But I think the jobs report that we got was far better than what anyone was expecting. So in that sense, it was a blowout jobs report. But I wanted to show everybody just the effect, though, that the great jobs report had on the T-bills, the treasury rates. So you can see here, the 30-year bond, I mean, basically everything came back down. This yield was sitting at 4.8% last week when I did this, and now it's down to 4.69. Very big drop there. The 10-year T-note was at almost 4.2% last week. That dropped all the way down to 4.052. So again, getting back to where I've been saying for months and months and months, this is exactly where we wanted it to be. We wanted it to be at 3.5% to 4%. That's kind of the key. That's the sweet spot. That's where we want it to be. So this falling down to almost 4% was really good. And so that was nice. The 5-year note, came up a little bit. Actually, well, this makes it was down, but it still kind of hovered in the same area, about 3.6%. So that means the yield curve kind of compressed a little bit because it was probably about 50 or a little over 50 basis point spread. Now it's down to about 40 basis points. So a little bit of compression there on the yield curve, but nothing too bad. And then now, what was the effect here on mortgage rates? So let's look at Yahoo Finance here for just a second. So mortgage and refinance interest rates today, as of February 14, 2026, 5.85% is the lowest rate we've seen in years. So that is fantastic news. So, and then just to read the little paragraph here. So mortgage rates vary by state and by who is reporting them. If you're looking for a rate below 6%, you'll like Zillow's system of compiling rates. According to Zillow, the current 30-year fixed rate is at 5.85%. Zillow obtains rates from its lender marketplace, so they're legit, okay? And it's the lowest report we've seen in years. So let's take a look at today's mortgage rates. So again, 30-year fixed rate mortgage, you know what? I might need to make that a little bit bigger just so everybody can see it. Let's make there we go. Much better. So these are today's mortgage rates. So 30-year fixed is 5.85%. 20-year fixed is at 5.64. 15-year fixed right now, 5.36%. I mean, fantastic. Absolutely fantastic. This is definitely going exactly where we want it. Like I said, I had said for many, many months that if we could get the 30-year fixed rate mortgage down to about 5.5%, that would make a world of difference in terms of just the residential housing market, in terms of getting deals rolling again. So today's mortgage refinance rates a little bit higher, but still pretty good. 30-year fixed rate at 5.97%, 15-year fixed at 5.39. So again, we're seeing interest rates go in the right direction, looking very good there. So that's nice. So like I said, just wanted to point out The treasury yields going back where we'd like them to, mortgage rates going where we'd like them to. So everything, looking very nice. So, all right. So let's take a look at inflation for a second, shall we? So we had two big reports this week. We had the inflation report and we had the jobs report. So let's take a look at inflation. So U.S. annual inflation rate slows sharply to 2.4% in January. Growth in consumer prices continue to stabilize to kick off 2026. So again, this was a great report. This showed that inflation is continuing to decrease, is going down exactly where we want it to go, which is fantastic. So price inflation further stabilized across the U.S. marketplace at the start of 2026, signaling consumer relief could be on the way in the year ahead. The annual inflation rate slowed to 2.4% in January, the lowest level since May, according to the Bureau of Labor Statistics data that was released on February 13th. This is down from the previous month's 2.7% and below the consensus estimate of 2.5%. So from December to January, consumer prices rose at a lower than expected pace of 0.2%. Core inflation, which strips out volatility, energy, and food prices, also eased to a 12-month rate of 2.5%, in line with economists' expectations. This represented the lowest level since March of 2021. On a monthly basis, core inflation jumped 0.3% from 0.2%. This is a clear sign that while inflation isn't gone, prices are cooling gradually. Stephen Cates, financial analyst at Bankrate, said in a note emailed to the Epoch Times. For households, this report brings mixed news. Lower gas prices offer comfortable breathing room, but it doesn't erase the cumulative price increases already baked in. That is true. That is not untrue. It's a true statement there. But I just want to point out that everything is going right where we wanted it to see. And again, when the Fed looks at should we decrease interest rates? Is it clear? Do we have a kind of a clear path for us to decrease interest rates? This is a key puzzle in that. And like I said, like I had been saying all through the end of last year. So the Federal Reserve, their own projections on inflation showed that inflation was going to top out in the fourth quarter of last year, and then it was going to steadily come down. It was going to steadily come down over the next 2 years, and as we got toward the end of 2027, that interest rates were going to be down below 2%. That was the Federal Reserve's own projections. So the question becomes then, like, well, what were they so freaked out about? You didn't get the inflation from tariffs. Inflation is actually coming back down. And what did we learn? I did, and I will keep reminding people on this. I did an episode, the Federal Reserve Bank of San Francisco put out a research paper on tariffs where they looked at 150 years of tariff results, tariff history, to try to understand, well, what could the effects of these tariffs be on our economy? And what they found, two main things in that report. Number one, tariffs are deflationary. They're not inflationary, they're deflationary. Why are they deflationary? Because they bring down economic activity. So they are deflationary by the way that they work. The second thing is they do have a tendency to increase job loss. They increase job losses in the economy. Reduction in jobs, reduction in the labor market. That is one of the side effects of tariffs. And again, so far, we have seen a little bit of that, right? Over the last 4 or 5 months, job report was very, very weak. Not horrific, but very, very weak. Now there are some other things there with the job report, which I'll get into in a minute. But I'm just pointing this out just to say that the boogeyman did not show up. The tariff boogeyman did not show up. Things with tariffs have been working very good. There's still a couple, chinks in there in the armor, so to speak. I'll get to that a little bit later when we get to the tariff news a little bit later on tonight. But so again, nothing's perfect, but it is working. That's the point. It's working. And this is going in the direction that we wanted it to go in. So this was a fantastic inflation report here. Obviously, the CPI showing cooling inflation, just like we were hoping for. The core inflation also decreasing. So just really good all the way around. Now, let's take a look at this here for just a second. So here's the inflation breakdown for January 26 in one chart. So I always like to show this to everybody because I think this is pretty good. So food at home. You can see here, food at home is up 2.9%. Cereal and bakery products up 3.1%. Meats, poultry, fish, and eggs up 2.2%. But notice how much eggs have come down. Eggs were up what? Eggs were up insane. It was like up 80% inflation in eggs. I mean, it was nuts how much that's down to 2.2%. Dairy is actually going negative here a little bit. Fruits and vegetables are just up a tiny bit. Non-alcoholic beverages and materials are up 4.5%. That was the biggest one. Other food at home up 2.1%, and then food away from home, in other words, eating out at restaurants, that's up 4%. I think that's one of the biggest ones, is that eating out. The cost of it, I think we've all seen that, we've all experienced that, right? Like, I mean, the cost of eating out has really gone up, and it is absolutely correct right now that you can definitely eat cheaper at the food store than you can eating out a lot. So that's where it's at the moment. As far as energy goes, gasoline prices down 7.5%. However, electricity up 6.3%. Piped gas services up 9.8%. So very interesting there. Now, obviously, electricity is up because of why? Well, that's up because of obviously AI, the building of the data centers, the siphoning of electricity out of these data centers to support AI. So that is what is driving electricity up at the moment. So, and then finally, we get into all other items. So apparel up about 1.7%. New vehicles just up a tad at 0.4%. I will have more to say on that in just a second, because obviously one of the big news this week was President Trump scrapping some of the EPA regulation that basically led to, a lot of what was going on with climate change, but also forced the auto companies to do, the stop-start mode in the engines and everything. So that stuff is all going away. That's going to help make vehicles a little bit cheaper, which is, every little bit helps. But like I said, I'll get to more of that in a minute. Medical care commodities up just a little bit. Rent of primary residences up 2.8%, but that has been falling, which is really good. Motor vehicle maintenance and repairs up 4.9%. Motor vehicle insurance up 4.9%. Airline fares up 2.2%. Alcoholic beverages up 2%, and then tobacco and smoking products up 8.5%. That's a little crazy. So, but like I said, overall, very good. Heading in the right direction, heading where we want it to be. So, all right, let's get into the employment report here for a minute. So the U.S. economy adds 130,000 new jobs. Unemployment rate dips down to 4.3%. The U.S. labor market shows signs of hiring momentum to kick off 2026. So the U.S. economy created 130,000 new jobs in January, suggesting employment conditions could be improved following months of sluggish labor market. Economists had anticipated only 70,000 new jobs. So the unemployment rate slipped down to 4.3% from 4.4% in December of 2025, lower than the consensus forecast, according to data from the Bureau of Labor Statistics released on February 11th. So the U.S. labor market could be turning a corner as hiring momentum accelerates at the start of the year. In January, the economy added 130,000 jobs, up from the previous month's downwardly adjusted 48,000. So the consensus estimates suggest the country had created 70,000 positions to kick off 2026. This also came in below market forecast, so the 4.4%. Healthcare was the top industry for job creation, adding 82,000 roles last month. Social assistance payrolls also increased by 42,000. Both industries have accounted for a sizable share of payroll growth over the past year, and experts have attributed their growth to an aging population. Construction added 33,000 jobs. Strong start for a sector in which there was little employment growth last year. Federal government employment fell by 34,000 as some federal employees who accepted a deferred resignation offer in 2025 came off federal payrolls, the Bureau said. Federal payrolls are down by 327,000 jobs, reaching a peak in October of 2024. As a result, the private sector created 172,000 new jobs, far higher than the 70,000 forecast. So I just want people to understand, because I think that is a very key thing to understand right now when you're talking about the basically when you're talking about the unemployment rate, when you're talking about the jobs that are created, that you have to take into consideration the number of federal government employees that are rolling off. Now, I want to show everybody a chart here real quick. If I could get this to come up, just hang with me for a second. Delinquency on student loans. I wanted to show, here we go. So let's take a look at this here. Federal employment. So federal employment reaches the lowest level since 1966. Federal employment is at its lowest level since 1960. I keep saying 1996, 1966. I mean, you could just look at that. I mean, that is incredible. I mean, basically that's basically going to be about 3 million jobs there right now in the government. And like I said, what did we say? We were down 327,000 jobs. So we come back to this. So that is about right. So you got a little over 3 million. Now you're down to about 2.7 million. So again, you have to just keep this in context. Keep this in mind when you're thinking about the unemployment numbers. Not unemployment. When you think about the employment numbers, that how you've got these two things going on. You've got this massive reduction in federal employees, but you've also got a rising of private payroll, the private employment sector. So again, we're seeing things, and I think what's interesting here is that you would hope that this decrease in government jobs will hopefully reduce the amount of government spending, right? Because that's less payroll costs for the government. So again, you're hoping that over the next couple of years, you begin to see the fruits of this as the government downsizes, as we get a smaller government that is hopefully still working very well for us. So, but all right, so let's go in. So the employment rate, so like I said, I just wanted to point that out. Now, let's talk about the revisions to the job numbers, because this was massive. We got another million jobs revision to the numbers. So in other words, there were 1 million jobs that they said were created that were not created. And this, again, and this continues, some of this was in 2025, but this continues to go back to the Biden administration. I just wanted to show you. So what sweeping revisions and a blowout month tell us about the U.S. job market? So this is a chart showing total change in non-farm payrolls from January of 2024. So you can see here, this line was the previous, and then we have the revised line in here. Growth in January accelerated, outpacing projections, but revisions cut estimated job growth in 2024 and 2025 by about 1 million jobs. 1 million jobs. And this is why the head of the Bureau of Labor Statistics got fired last year, because they have been cooking the books. They have been putting out bogus, and I've been saying this for a long time now. They were putting out all through the Biden administration. They were putting out bogus, totally bogus job numbers. And you have to keep in mind, this million job revision here, this is on top. It's on top of the million job revisions that we already got a year ago. So this is 2 million jobs, a little over 2 million jobs that were just totally fake. They're just totally made up. And that's a problem, because one of the biggest things that I've been saying for the last couple of years is that these economic indicators, these numbers that we get, are so very important. They are so critical, because companies have to make decisions based on these numbers that they're getting. In other words, they look at, oh, okay, well, the labor market looks like it's in the toilet. I don't know, maybe I shouldn't be hiring right now. They look at the GDP numbers. Well, GDP is not looking too good, or unemployment's in the toilet. Maybe I shouldn't do that. Inflation's on the rise or whatever. But if they see numbers where it's like that, oh, hey, the jobs are looking great. Hey, everybody's hiring, everything's good. This is probably okay for me to hire. Companies start making really bad decisions. And what have we seen? What have we seen recently? We've seen all these guys, all these companies in Silicon Valley. We've also seen FedEx and everybody. What are they doing? Cutting jobs like crazy. And why is that? And I'm not saying this is the end all be all of their decision making. A big part of it was COVID and hiring, over hiring people after COVID. And so they're kind of trimming the fat, so to speak, right now. So that's a big part of it. But this does play into that. And that's what I need people to think about. I need people to realize that this plays into that. We cannot have, I don't care whether it's Republican or Democrat, it's got nothing to do with that. We cannot have these numbers being manipulated. People, businesses, business owners, CEOs, chief financial officers, they have to be able to rely on these numbers in terms of making decisions that run their business. If they get bogus numbers, it's going to lead them to bad decisions, which is ultimately going to hurt their businesses in the long run. So we just can't have this. And but like I said, I digress. I know I hopped on my soapbox there for a minute, but let's just look at this for a second. So the American workforce is increasingly donning scrubs. January's strong job reports and sweeping revisions that slash job numbers for the past 2 years show how much the U.S. labor market is transforming. The mixed jobs picture reflects surging demand for people in healthcare and social services, but a bleaker environment for government employees, factory workers, and cubicle dwellers. Come on, man, cubicle dwellers, really? Anyway, so we got, kind of losers and winners here. So obviously healthcare doing really good, social assistance doing good, leisure and hospitality has really picked up, but hospitality and leisure has decreased. Government's decreased. Construction is, kind of not really, kind of idle, if you will. Private education has increased a little bit, but finance is going down. Transportation and warehousing, professional services going down, wholesale, information, retail, temporary help, manufacturing. So, and then we get into healthcare. So change in non-farm payroll since January of 2024. So healthcare and social assistance way up. Now, I want everybody to keep in mind, you have to keep this in mind. Why is that way up? Why is healthcare and social assistance way up? Well, it's way up because the government is subsidizing it. The government is pumping all that money into healthcare. Remember, I talked about what was Congress just fighting about? The Obamacare subsidies, the other healthcare insurance company subsidies. That was the big ticket. See, they know that right now healthcare is the big driver right now in the jobs market, and it is the driver because the government continues to subsidize it. If the government stops subsidizing it, you're going to see that drop off real quick. You're going to start to see hospitals and health insurers and everything start to lay people off. So they know this, they understand this. However, and again, I don't want to get too far down the rabbit hole on that on healthcare and stuff, but I just, like I said, I have an article that I'm going to show everybody. We're going to talk about student loans a little bit later on tonight. And when we look at that article, you're going to see that some of the reforms in the student loan market, wait for it, are going to lead to colleges reducing their tuition. I know that's a shock to everybody, but you cut off the government assistance, and amazingly, the prices come down. I know it's shocking. That's shocking. So, now, if you decrease the subsidies in healthcare, this is why, like a couple weeks ago, Trump was basically saying that he wanted to change the healthcare system as far as he wanted to give the money to people. So basically say, hey, we'll give the money to the people, and then we'll let them go out and use that money to go buy their own healthcare coverage. And that sounds like a good idea. And the reason why he's saying that is because he knows he probably couldn't get Congress to cut the money out to reduce the spending, which is absolutely what they should do, because you're not going to be able to get prices down unless you reduce the spending by government. You have to reduce the subsidies. Now, in the short run, that's going to cause a lot of upheaval in the healthcare sector. That's going to cause some layoffs and things like that. But in the long run, it's going to stabilize, and the hospitals, everything will be better for it. Our health insurance will be better for it. I'm not saying it's going to make a dramatic change, but it will bring eventually the health insurance costs will come down. But they will not come down. This is what I can tell you with 100% certainty. They will not come down as long as the government continues to subsidize the healthcare system and continues to pump an endless amount of money into it. That's for sure what won't happen. So all that's going to happen is our healthcare insurance costs will just continue to go up and up and up every single year. All right, let's and then it goes into like empty cubicles here. We talk about like financial activities, information systems, professional and business services continue to decrease. Blue collar blues, change in manufacturing payrolls. However, you notice you started to see a slight little blip up here at the beginning of the year. So I would be patient on this one because, again, I know the business media loves to just, the Wall Street Journal last week had an article about like, Trump promised all these manufacturing jobs and nothing has happened yet. Everything, manufacturing still way down and this, that, and the other thing. Hey, just give it time, give it a little bit of time. You're just starting to see a little blip here, but I think you're going to start to see this you're going to start to see like a hockey stick here. You're going to start to see this go right back up here over the next 2 years. You're going to see that shoot right back up. So like I said, just keep an eye on that one. Data centers everywhere, change in construction payrolls. So non-residential, heavy construction and civil engineering up, but residential is down. Immigration impact. So, our let's see here, unemployment rate still, like I said, down to 4.4%. So still in a good spot there. So, all right. And then I just wanted to show everybody this. So this is the key report here when you're talking about the quarterly census of unemployment and wages and the revisions to these wages. What you look at here, and this is the Bureau of Labor Statistics. This is their website. So this is where the report is called the QCEW, the Quarterly Census of Employment and Wages. And basically it just says here, the program publishes a quarterly count of employment and wages reported by employers covering more than 95% of U.S. jobs available at the county, MSA, state, and national levels by industry. So I'm not going to bore everybody to death by going deep into this. But I just wanted to show everybody that this is where you can find a lot of this information on the Bureau of Labor Statistics website. So you just go on here, bls.gov/CEW, and you can find this report. And like I said, again, this is the QCEW report, quarterly report that comes out. But they also do another report too that's more of like they have the quarterly, but I think they also have an annual report that they put out too, or maybe it's not annual. Maybe it's just in January or February. The report they put out is just a bigger report. I forget. I'd have to dig a little bit deeper into this. But like I said, the point is that if you're looking for the revisions to the jobs data, this is where you're going to come to find it. So that's like I said. I just wanted to point that out to everybody. Okay, going on to a couple other things here. So U.S. retail sales unexpectedly flat in December. So the softer than expected data feed into economists' concerns about a fragile consumer economy. So the U.S. retail sales were flat in December, a disappointing data point for economists who had expected growth despite concerns about a fragile consumer economy. Sales at U.S. stores were roughly unchanged in December versus November at $735 billion, after rising by 0.6% in November, the Commerce Department said Tuesday. Analysts polled by the Wall Street Journal were anticipating a 0.4% increase. Overall, in 2025, total sales by retailers grew by 3.7% in December. Sales declines at car dealers, furniture, and electronic stores were offset by sales growth at sellers of building materials, food and beverages, and gasoline. The figures are seasonally adjusted, but not adjusted for inflation. The extended pause in retail sales growth would likely put economists on edge. Steady consumer spending has helped insulate an economy jolted last year by sweeping trade and immigration policy changes and a weaker yet still solid labor market. Wealthier shoppers also got a big boost from 2025's roaring stock market, although trading has been bumpier so far in 2016. American shoppers have powered ahead so far this decade, lifted by the economic boom that followed the pandemic. Even searing inflation early in the 2020s and the resulting higher price levels haven't derailed spending despite frustrations about the cost of daily necessities. Most economists see any potential rise in job losses as the main threat to consumer spending and economic growth as a whole. The January jobs report, which basically did, like I said, came out and was good. So again, the jobs are holding steady. The jobs are holding steady. So the main threat, if economists see that as the main threat to spending and economic growth as a whole, we're still okay there. That's still all right. So, but like I said, retail sales came in a little bit weaker than what most people were looking for. Now, I just wanted to point this out real quick here. So Treasury Secretary says the Fed will likely take its time to further reduce its balance sheet. So as of last week, the Fed's balance sheet sat at 6.6 trillion. If everybody remembers, and I've talked about this kind of at length, but the Federal Reserve, their balance sheet after the pandemic, after in 2021, there had ballooned up to $9 trillion. And they basically, and Jeremy Powell has been bringing that balance sheet brought it back to about 6.5 trillion. It's jumped up a little bit there to 6.6 trillion. However, and I detailed this, and I'll probably go over it again in the next week or two, but I did a whole detailed breakdown on this a couple of weeks ago at the beginning of the year, where I showed, the repo market. And I tried to explain to everybody about the repo market and what the Federal Reserve has done with the repo market over the last 16, 17 years, by putting the repo market as the, basically the center of liquidity in the market in a very real way. And the money in the trading in the repo market is what kind of greases the wheels of the market, so to speak. So, and one of the side effects to bringing down the Fed's balance sheet is that they drained all the liquidity out of the repo market. Not good. And so we've been seeing these spike ups. Now, it's been a little quieter recently in the last month or so. And I believe the reason why that has quieted down a little bit is because the Fed has stopped reducing, and now they are buying again a little bit, which wink, wink, as to them is not quantitative easing. It is quantitative easing. It's a very, very light form of quantitative easing, but it is quantitative easing. But anyway, so they're not going to be putting much of an emphasis in making any kind of dramatic reduction in their balance sheet anytime soon because of that. So, but let's read here for just a second. So Treasury Secretary Scott Bessent said on February 8th that he does not expect the Federal Reserve to quickly move to reduce its balance sheet, even under the potential leadership of Fed Chair nominee Kevin Warsh, a critic of the central bank's bond purchases. During an interview with Fox News Sunday Morning Futures, basically, Maria Bartiromo raised concerns about the Fed's balance sheet, particularly after the 2008 financial crisis, when the central bank bought large quantities of government bonds and other securities to stimulate the economy and lower long-term interest rates, a practice known as quantitative easing. The unorthodox practice resulted in the Fed more than quadrupling its balance sheet over a 7-year period to 45 trillion by 2015. The balance sheet rocketed up again during the COVID-19 pandemic, reaching a high of 8.97 trillion, basically $9 trillion in 2022, but has mostly declined since early 2023, dropping down to 6.5 trillion in December of 2025. But Bessent told Bartiromo that whatever happens to the balance sheet will be up to the Fed in terms of what they want to do. I wouldn't expect them to do anything quickly. They've moved to an ample regime policy, and that doesn't require a larger balance sheet, he said. I would think that they'll probably sit back, take at least a year to decide what they want to do. 2 months ago, the Fed started purchasing Treasury bills to grow its stock of bond holdings in an effort to bolster liquidity in the financial system and secure firm control over the target range of its interest rates. So that's the key paragraph right there as to what I was just saying. 2 months ago, the Fed started purchasing Treasury bills, i.e. quantitative easing, to grow its stock of bond holdings in an effort to, wait for it, what? To bolster liquidity in the financial system and secure firm control over the target range of its interest rates. So, in other words, and this is also why I said that it would be next to impossible for the Fed to fully bring down their balance sheet because of what they have done with the repo market. And like I said, the way that they have positioned that. Now, again, there's nothing that can't be undone. The problem is, what are the consequences? Like there's a yin and a yang to everything in the market. So if the Federal Reserve starts bringing their balance sheet down too much, they drain the liquidity out of the market, which then causes massive liquidity shocks. It causes liquidity problems. A lot of these big corporations, they can't, they can't, manage their liquidity correctly. It puts them into a bind. They start having problems. You get delinquencies, you get defaults, you get all kinds of things that rocks the stock market. Stock market drops, everything. It just goes from there. So the Fed recognized all this. Believe me, they saw this. Jeremy Powell didn't want to talk about this in his press conference, but this is exactly what they saw. And somebody went to Jeremy Powell and said, "Yo, you better back off reducing the balance sheet because you're about to cause a major liquidity crisis in the market." And people are going to say, "Well, why is this happening?" And guess what? It's going to come right back to you. They're going to say, "Oh, well, this is happening because Jeremy Powell keeps reducing the Fed's balance sheet." So there are all kinds of side effects and basically what you could call unintended consequences to whatever decisions the Fed is going to make. And that's why this is not good, because the Fed has really put themselves in a box in a very real way. Again, go back to another shameless plug for my Lords of Easy Money series. Again, you have to go back. You have to look at that. Get the book, The Lords of Easy Money. Read that book. You will understand. It will become crystal clear to you exactly what's going on in the economy today. You will understand everything that the Fed did and how it has manipulated the market in a very real way, put the market on its head, and has really distorted a lot of stuff in the market. And that's a lot what Kevin Warsh, the new Fed chairman who's coming in, that's a lot of the stuff that he has talked about, is a lot of the ramifications of the things that the Fed did for years with the zero interest rate policy and the quantitative easing and just ballooning their balance sheet and all this other stuff, and how it has in a very real way distorted large parts of the market. So I just did an episode that came out this morning. It came out 12 o'clock today. I did an episode on Kevin Warsh and basically, will he be able to fix the economy? And so I would highly tell everyone to check that episode out, because I go into detail about all this stuff that we're talking about here. So, but anyway, all right, let's move on to some other things here. So I thought this was really interesting. So President Trump sat down and he did this interview with Larry Kudlow. And he basically says in here, interest rates, like this country should have the lowest interest rates in the world. So President tells Larry Kudlow that Fed Chair Jeremy Powell is so bad and rates should be cut by 2 points. So I just wanted to point this out to everybody. The president is saying he wants interest rates cut by 2 points. So you have a federal funds rate right now that is sitting at 3.75 to 4% range, and President Trump is saying that he wants that cut by 2 percentage points. So he wants that down to the 1.75 to 2% range. Is that doable? Yes. Would I recommend that to the Fed? No. Because ultimately what Trump is saying there is what he wants is we talked about the mortgage rates. You come back here. So we talk about the mortgage rates here. And right now the 30-year is sitting at 5.85%. So in other words, what he wants is mortgage rates to come back down to 4%. He wants 4% mortgage rates again, because I think that there are probably economic advisors there in the White House that have basically told him, and I'm sure he's talked to a lot of people. And look, he was a real estate developer. He knows the real estate market. And I'm sure that there are other people from probably some of the big home builders like, Pulte and NV Homes and Toll Brothers. I'm sure that they have spoken to him and probably said, hey, the only way you're really going to get this market really turned around and really humming again, at least the residential market, is if we have 4% interest rates again. And so I'm sure I'm sure that has been said to him, and that's why he's harping on that. Another aspect of the interest rates is the national debt. Like, in other words, if we go back to the bonds here for just a second. So when we look at this, we have all these different bills. We have the 1 month, the 3 month, the 6 month, the 1 year bill, the 2 year, 3 year treasury yield or treasury notes, 7 year, 10 year. So when you are in the shorter term, when you're in the 1 year bills or lower, those bills have to be rolled over. Like, what happens? Like, okay, you buy a 6 month bill. Well, what happens after 6 months? Well, that debt has to get rolled. If you've got a 1 year, it's got to get rolled. A 2 year, so everything's got to get rolled. And if it gets rolled, a lot of times it has to get rolled at higher rates. So this is one of the big things, and they know. Scott Bessent, the Treasury Secretary, the President, they understand that there is a huge chunk, upwards of $8-9 trillion every year of national debt that's got to get rolled over in these bills. And so a big part of the reason why he wants the rates lower is because he wants to reduce this. And again, when we go back to our big chart here and we see that the interest on the national debt is $989 billion, almost $1 trillion, he wants to reduce that interest cost. He wants to bring that down. If you bring this down another 2 basis points, that's going to make not a ginormous difference, but it's going to make a dent in the interest that is paid on the national debt. That's a big reason why he wants to go and push that down. So there's 2 reasons there, right? It's one thing is getting the residential market started. The other thing is helping with the financing of the national debt and reducing the overall cost of that national debt to taxpayers. So that's I'm just trying to give everybody like the rationale, like why does he want to do that? Why does he think that would help us? So, but let's look at this for just a second here. So this country should have the lowest interest rates in the world. Trump told Larry Kudlow, we keep the world going. Trump tied interest rates to government interest expense, saying that the changes of a few points could significantly alter federal finances, what I just said. Every point is 600 billion, Trump said. So all he has to do, if we went down 2 points, we don't have a deficit anymore, he claims. I don't know totally about that, but he's not far off. He's not totally incorrect there. Market milestone. Trump also pointed to a recent market milestone as evidence of economic strength, telling Kudlow he remembers predictions that the Dow Jones Industrial Average reaching 50,000 would be considered a miracle by the end of a presidential term. But again, so he's pumping the, but let's see. But there was something else. I thought there was one more thing. They talked about the Warsh nomination, Switzerland tariffs, but all right. So, but let me just get back to a second to the 2%. Like, even though obviously it could be done. Should it be done? And I have made the argument before many times that I thought, again, if we go back to the summer of last year, I had basically said, I'd made the argument that I thought interest rates should come down somewhere between a point to a point and a half. 100 to 150 basis points. That was the sweet spot. That's where we needed to be. Now, I would have liked Jeremy Powell to be a lot more aggressive in bringing rates down. I think he should have done rate reductions a lot sooner in the year last year, and I think he should have been, at least initially, a lot more aggressive. I would have liked to have seen is probably two 50 basis point rate reductions and then a couple of 25 basis point rate reductions. You bring it down 100, like I said, bring it down 150 basis points, and you're done. You're good. You just brought it down 150 basis points. Hey, some might argue you should still do more, but whatever. But Powell only brought it down 75 basis points. So I think we should have more rate cuts. I think this should come down further. Should it come down 2 points? I really don't know about that. That just seems way too aggressive. And like I said before, part of the thinking here, and in other words, what would be, playing devil's advocate, why would you not want to reduce interest rates by 2 basis points? Well, if something happens, if you do have a recession, or again, the stock market, something blows up, something starts going sideways, right? You sit there and you go, okay, well, then if the Federal Reserve reduces by that much, by 2 basis points, that doesn't leave them a whole lot of room left to work with if something happens and they have to reduce rates further. That would be my big concern, and I'm sure that is some of the thought process and concern of some of the people over at the Federal Reserve. Kevin Warsh is absolutely going to be thinking about that. And the other reason why I wanted to point this out, and this goes back again to the episode I put out this morning, talking about Kevin Warsh, because I get into the whole interest rates. Kevin is not necessarily on board with this. Kevin is not necessarily on board with this dramatic reduction in interest rates. I think Kevin's more aligned on my thinking, where it's like, okay, yeah, we'd bring it down probably another 75 basis points, because you add that to what Powell's already done, that brings you down 150 basis points. Like I said, I think that's really more where his head is. It is definitely not this 2%, 2-point reduction. So, I find this interesting that, again, Trump's beaten Powell up, and Powell has relented a little bit here in recent months, but now I think Powell's done. I don't think Powell's going to do anything else until he leaves in May. But he picked Kevin Warsh, and he's going to put Kevin Warsh in there, and like I said, are we going to see? And this is one of my big worries, is that was Kevin Warsh the right guy? Like, was he the right guy? If Trump wants somebody to bring down rates massively like this, I don't know that Kevin Warsh is going to do that, and then are we going to see a situation where, Kevin Warsh gets in there, and 6 months later, toward the end of this year, Trump's, berating him and beating him up because, he didn't bring rates down by 200 basis points, So, again, it's gonna be real interesting to see how some of this plays out. So again, like I said, I just want to show this because I thought it was real interesting, just to give some insight as to, where the president is, what the president is looking for, what the president is looking for in terms of interest rate reductions. Give a little bit of flavor for why I think we either should or shouldn't do that, and what the new Federal Reserve Chair, Kevin Warsh, could or may not potentially do when he gets in there. So I think it's just thinking that out, thinking that through, and looking through that discussion. So now let's get to this for a second. So the EPA rescinds Obama-era finding that served as basis for climate regulation. The Trump administration eliminated a 2009 finding that 6 greenhouse gases are a danger to public health. So, President Donald Trump and Environmental Protection Agency Administrator Lee Zeldin on February 12th announced the elimination of 2009 finding that served as the basis of U.S. action to regulate greenhouse gas emissions. Effective immediately, we are repealing the ridiculous endangerment finding and terminating all additional green emission standards imposed unnecessarily on vehicle models and engines between 2012 and 2027 and beyond, Trump said during an event at the White House. These crippling restrictions are a major factor in driving up car prices to unprecedented levels, and the car that you were getting was not nearly as good. Leaders rescinded the agency's endangerment finding from 2009, established under the Obama administration, which declared that 6 gases, carbon dioxide, hydrofluorocarbons, methane, nitrous oxide, perfluorocarbons, and sulfur hexafluoride pose a danger to public health. The EPA's 2009 ruling concluded that the gases endangered current and future public health and contributed to climate change. Subsequent regulations based on the finding include vehicle emission standards, the Clean Power Plan, and other limits on methane, oil, and gas. This determination has no basis in fact, none whatsoever, and it had no basis in law, Trump said, emphasizing the role fossil fuels play in energy production worldwide. So, what does this mean for us in a nutshell? Well, I think this will immediately, and I saw another article, but I couldn't find that for some reason, but I saw another article that basically said that just this one move would basically reduce the cost of the average car by $2,500. Just like that, just boom, right off the top, $2,500, a reduction. This is also, if anybody out there has, the car that's got the, the auto stop and start, every time you come to a red light, the thing shuts off and then starts up again. That thing drove me nuts. I had, thankfully I've never owned a car that did that, but I've had a bunch of rental cars that did that. And oh man, did that drive me nuts. I absolutely hated it. Drove me up the wall. So again, I think this is going to be really interesting because this is going to say, again, it's cutting the red tape and bureaucracy that did not help a lot of stuff to begin with, but did drive up the cost of a lot of different things in our lives. So I think this will be a really good thing at the end of the day. So let's just keep an eye out on that. Now, so let's talk about this bill that's running through Congress right now. So again, what happened? So Trump came out a couple of weeks ago and said he wanted to put a ban on companies like BlackRock and State Street, Blackstone from being able to come in and basically buy up a ton of residential properties to just turn them into rental properties. So, however, this proposed ban on investors in the housing market hits a wall in Congress. White House is pressuring GOP in Congress to add an investor ban to existing housing bills, but lawmakers have pushed back. So the White House is at loggerheads with Congress over one of President Donald Trump's signature housing proposals, a ban on Wall Street investors buying single-family homes. Trump officials pressured congressional Republicans in recent weeks to include the investor ban as an amendment in either of the major housing bills currently winding through the House and the Senate, according to people familiar with the matter. But lawmakers in both chambers have resisted adding the investor ban, which traditional free market advocates, Wall Street executives, and the home builder industry generally oppose. Any such amendment could derail the bipartisan momentum behind both housing packages that have been in the works for months. The House overwhelmingly voted in favor of the bill on Monday evening, passing it by a 390-9 vote. The Senate approved similar legislation last fall. The two chambers will look to reconcile their respective bills in the months ahead. Shortly before the vote, the Office of Management and Budget issued a statement to House members reiterating the administration's insistence on including the investor ban on an amendment. The bill lacks other presidential priorities, particularly a ban on the purchase of single-family homes by large institutional investors. So, lawmaker pushback to Trump's investor ban shows how the White House and Congress favor different approaches to addressing America's housing crisis, which sent sales last year to a 30-year low. Home values have soared by more than 50% since 2019 and are pricing out many first-time home buyers. So, yeah, and a part of what's happening is these investors buying up all these residential houses. I don't think this should be allowed. I've been saying this for well over the last couple of years, and I was so happy to see Trump do this. Now, again, the cynical part of me basically says, oh, this isn't shocking. There's nothing shocking about this. This is BlackRock throwing their money around. This is Blackstone throwing their money around. This is State Street throwing their money around. And they have a lot of money to throw around Congress and throw around the Senate. They buy congressmen and senators every day of the week. So this is the cynical part of me basically saying that they, got on the phone and basically said, hey, I remember all that money I gave you last couple times around to get you reelected. Yeah, if you want that check again, you better not vote for this. You better not stop us from being able to continue to buy up all these residential houses. So, and then here is another thing. So basically, housing affordability package set to advance in Congress amid home cost concerns. So yeah, these bills and these packages are advancing. They're going to get approved. They're going to go through. The real question here is, will the president sign them, or will Trump veto these bills at the end of the day because they did not include his ban on, BlackRock and Blackstone and State Street from being able to gobble up residential houses and turn them into investment properties, further driving up the price of housing and further driving up the price of rents. So again, this has been a really horrible thing to have these big Wall Street firms buying up all these residential houses. This has not been a good thing. And I hope that, something can be worked out or added on here or something, but it's not looking too good at the moment. So, all right. Do I want to get into, I just want to know if I wanted to get into I wanted to show you guys some bank numbers here real quick, but I think I might hold off on this for just a second. Oh, you know what? I forgot to pull up here. Hold on one second, guys. Give me a second here. Let me pull this up. Where is it? Hang on here just a second. What is this? Okay, because I want to show everybody this. All right. Here we go. Here is our economic indicators right here. So, all right. So I'm going to switch gears for just a second here, everybody. I'm going to go into, so this is the part of the program where I usually get into, I like to go through economic indicators. I like to talk about the episodes I put out this week, and then I like to give everybody a bunch of banking news. So let's jump into the economic indicators real quick, shall we? So, and as we can see on the chart here and everything. So on Tuesday, February 17th, the ADP Employment Change Weekly, we got the New York Empire State Manufacturing Index. On Wednesday, February 18th, we get the durable goods orders, the building permits, housing starts, Atlanta Fed GDP now for the fourth quarter of 2025, 20-year bond auction, the Federal Open Markets Committee meeting minutes. On Thursday, February 19th, we get initial jobless claims, continuing jobless claims, goods trade balance, Philadelphia Fed Manufacturing Index, the trade balance, pending home sales. And then finally, on Friday, February 20th, we're going to get the Personal Consumption Expenditures Price Index, GDP for the fourth quarter of 2025, personal spending, manufacturing Purchasing Managers Index, the Services Purchasing Managers Index, new home sales, and the U.S. Baker Hughes total rig count. So we got a lot of economic indicators coming out this week, a lot of housing information, GDP information. That 20-year bond auction, we'll be keeping an eye on that to see how that goes. And then obviously the FOMC meeting minutes, that I'm sure people will be paying close attention to that. So, okay, now let me go into, let me throw this over here for a second. All right. Let me go into the episodes that I put out this week. So I actually did 6 episodes this week, and we started with Monday with the rise of the invitation-only stock market as billionaire population surges. So the number of stocks for people to invest in has been shrinking since the 1990s. However, a new market has risen for the ultra-wealthy, wherein they can invest in private companies through invitation-only transactions. This is before a company company goes through an initial public offering, otherwise known as an IPO. Is this creating a two-tier system? This is happening at a time when the world's billionaire population is surging. According to UBS, global billionaire wealth hit a record 18.5 trillion in 2025. So again, I thought that was a really interesting topic, talking about this invitation only stock market where really the uber wealthy are getting a chance to jump in on private companies and buy shares in private companies before they would get to the public exchanges. And one of the things they're talking about is that, again, a company does an IPO, they get initialed, and people are able to, most people are able to buy those shares and the stock, through their 401ks and through investment accounts and things like that. But the point is, it's kind of like this old saying, who's at the nozzle first, right? Who gets to the nozzle first? Well, if you're a billionaire, or if you're, I don't know, if you're worth a couple $100 million and you're able to get in on some of these private companies before they go public, your return is going to be exponentially better than somebody who gets to that thing after they've gone public. Not to say that your return, but investing in them after their IPO, not to say that return is going to be terrible or it's going to be horrible. It's just not going to be anywhere near as good as what the people who are getting in at the earliest point are going to see. And it's about adding to the income inequality. In other words, the rich. It's the old adage. The rich continue to get richer. All that kind of stuff. So, but again, I just thought that this was really interesting. And another interesting aspect of this is the first thing: the number of stocks for people to invest in has been shrinking since the 1990s. That is absolutely 100% true. The number of publicly traded companies in the stock market has been shrinking by a lot since the 1990s. That's not a good thing. We really need to get more companies to go public. However, as long as you're seeing what's happening now with with these very wealthy individuals being able to buy shares of private companies, that is going to delay a lot of these companies going through the IPO, because again, what's the point of doing an IPO? Well, you do an IPO because you need capital, because you have a company that you think is going to be able to grow dramatically. They're going to be able to take that newfound capital and they're going to be able to leverage that into a massive amount of future growth. That's the whole point of going through an IPO. But if they can get that capital, if they can get those funds privately beforehand, without, basically in the same method, just, it's just a private, stock transaction. If they can do it that way, first of all, they save themselves a ton of money by not having to go through the IPO. And it also puts off them having to do the IPO because they got the capital that they needed to grow. So they don't need to do the IPO. So again, I point this out because I think there are a lot of different ramifications here for this, and hopefully some things that people will start to give a lot of deep thought to, because again, we need a robust market where we get a lot of companies become publicly traded, and because that's the whole thing. That's how we kind of keep our stock market flowing. That's how we keep the edge of the American economy, is that we always have new companies coming in and flowing and growing, and the new at some point becomes the mature and replaces the old. And that's been the name of the game on Wall Street for 150 years. So we need that to continue. That's why I bring it up. So anyway, okay. And then on Tuesday, is the crypto winter of 2026 upon us? I did another installment of the crypto series. We're now up to this. That was the 35th episode now. So this series focused on, is the new crypto winter upon us? Bitcoin has witnessed its worst drop in 3 years, dropping to as low as 60,000. Some market analysts believe Bitcoin could drop as low as 40,000 before it stabilizes. Now, why is Bitcoin falling? It could be a combination of things: profit taking, short selling, and the uncertainty around crypto legislation. We also consider crypto holding companies and where crypto legislation currently stands. Michael Saylor's company Strategy is in serious trouble as the price drop of Bitcoin falls below their average purchase price of around 76,000 per Bitcoin. Treasury Secretary Scott Bessent delivered remarks last week in which he stated that he is a champion of community banks and wants to avoid any deposit volatility resulting from digital assets market structure legislation. So in other words, he's in favor of the banks in the proposed crypto legislation that's being argued about right now. So that was part 35 of the crypto series. I would highly suggest people check out the crypto series. I think I've got a lot of fascinating and really I cover all kinds of interesting finance related stories in there in the crypto series, kind of anything and everything crypto, fraud, crazy stories, the history of crypto. Like if you want to understand a little bit more background on what crypto is, how it works, all that, it's all covered there in the crypto series. So highly recommend people check that out when they get a chance. So then on Wednesday, I did Santander acquires Webster Financial and other M&A activity. So the M&A market for banks continues to heat up with several recently announced transactions. Santander is buying Webster Financial for $12.3 billion. Columbia Bank is buying Northfield Bank for $597 million. Stockyards Bancorp is buying Field and Main Bancorp for $105 million. Prosperity Bankshares is buying Stellar Bancorp for $2 billion. There have been 14 deals announced to start 2026, and median deal value to tangible common equity has increased to 191.9%. So, but how do investment bankers feel about the current market? Should banks go all in on M&A? What do acquirers want? So again, I talked about so a number of the recent M&A transactions that just happened in the last few weeks, and then just kind of give an update on where the bank M&A market is so far to start 2026, and how are investment bankers feeling about it, and what do acquirers, what are they looking for right now? What do they really want to get out of M&A at the moment? So again, check that out when you get a second. Then on Thursday, I did Metropolitan Capital Bank and Trust becomes the first bank failure of 2026. So Metropolitan Capital Bank and Trust in Chicago is the first bank failure of 2026. On Friday, January 30th, the Illinois Department of Financial and Professional Regulation closed the single branch $261 million asset bank. The FDIC was appointed as receiver and sold most of the assets and liabilities of the bank to Detroit-based First Independence Bank. The IDFPR stated that Metropolitan Capital was closed due to unsafe and unsound conditions and an impaired capital position. This failure is estimated to result in a $19.7 million cost to the FDIC insurance fund. This episode also looked at two credit unions that were placed into conservatorship. So this episode examined a couple of different articles there. But again, we have our first bank failure of 2026. I covered it there. And I would just remind people, we don't have the whole story yet. A lot of times, as I have explained in other bank failures that I have examined here over the last year and a half, some of the bank failures in 24 and 25, it takes a little while. Like it usually it's not uncommon for it could take 6 months, it could take a year for the real story of why a particular bank failed to kind of come out. And a lot of that has to do with legal actions, could be lawsuits. The Department of Justice, the FDIC could decide to go after bank executives or board members or whatever. So sometimes they don't. Sometimes it's just incompetence that fails a bank. But a lot of times it's fraud and mishandling and different things going on there. So again, I would not be shocked if we get more information on this failure. But like I said, it was the first bank failure of 2026. So I wanted to cover it, wanted to bring it to everybody, just so we covered that. And then on Friday, I did how are neobanks doing? So neobanks are currently facing some of the same difficulties as banks. The problems include cooling funding, rising customer acquisition costs, and investors increasingly focused on profits. As the hyper growth for neobanks is cooled, a small group has emerged as leaders. These neobanks include Revolut, Monzo, and Chime. What can banks learn from this changing landscape? Well, the blog post that we examined in this episode offers 5 lessons. They include number 1, digital convenience always wins customers. Number 2, profitability is hard. Number 3, trust and retention still favor relationship banking. Number 4, reliable SMB tools are becoming table stakes. And number 5, this is not a signal to slow digital investments. And then finally, we review a list of the top 10 neobanks in the US and globally. So, really liked this episode. Had a little bit of fun with this episode because I think that some of the neobanks are really interesting to look at. Like I said, Chime, Monzo, Revolut, and a lot of these banks are coming from Europe, coming overseas. So again, and just looking at what some of them are doing. But as the neobank market, and again, to tell everybody, like, so what is a neobank? A neobank is just a purely digital bank. It's a bank that's purely online, doesn't have any branches, doesn't have any physical presence. It's just a purely digital online bank. So that's what a neobank is. But it's really interesting to see some of their some of these neobanks, like some of their models, and like Chime, for example. Like Chime, I find really interesting. So Chime just went public. They just issued an IPO. So now what's the nice thing about them going public is that they have to give us all of their financial information now. People got a chance to look under the hood and see what was going on. One of the most interesting things they found about Chime was the amount of money that they spend on customer acquisition, basically marketing. The amount of money that they're spending on customer acquisition is astronomical. It's huge. And basically, and one of the interesting things there is that they're not going to be able to continue that forever. No company can continue to indefinitely spend an exorbitant amount of money acquiring new customers. At a certain point, you have to scale that back, and I don't care that they don't have branches. They don't have it, because people said, they'll be like, oh, well, they don't have the cost of all that physical stuff, so they can afford to do it. No. No company, I don't care what your situation, you just can't afford that, forever, and that hyper growth is going to cool at some point, so, which we're already seeing now. So now, as these neobanks are maturing, they're starting to recognize that, oh my gosh, we're having some of the same problems that just traditional everyday banks have. So again, I thought it was interesting. I thought it was great to kind of do a look in on neobanks and see what they're doing, how they're going, how things are going. And it turns out that a lot of them are struggling and they're running into a lot of issues that, a lot of typical banks deal with. So just thought that was interesting. And then earlier today, 12 o'clock today, I did, can Kevin Warsh fix the problems at the Federal Reserve and the U.S. economy? So Kevin Warsh was just named by President Trump to be the next chairman of the Federal Reserve. Mr. Warsh has a monumental task before him, and not only fixing the mistakes of the Federal Reserve, but trying to fix the problems that have metastasized in the U.S. economy. Can Mr. Warsh fix the misallocation of capital that was caused by the Fed's zero interest rate policy, the persistent inflation, the goosing of the riskiest and least productive assets, and perhaps most importantly, the addiction to debt in the United States? So I think that was a really, really good episode. I used an article that was written by Jeffrey Tucker. If anybody doesn't know who Jeffrey Tucker is, I highly suggest you go to X and follow him. Jeffrey Tucker puts out some excellent content. He's a regular contributor to the Epoch Times. And again, but he's one of my favorite economists. I love following Jeffrey Tucker. Love looking at a lot of the things that the way that he looks at the economy, the way that he considers a lot of different economic issues. So, but that article by Jeffrey Tucker was excellent, and I gave that a lot of coverage. And again, Kevin Warsh he's got a lot of really difficult challenges in front of him coming down the pike. So, all right. So those are the 6 episodes that I put out this week. Now I want to bring everybody some bank news. So, this first thing was really, really interesting. So there is a merger. Actually, the merger is being called off, but there was a merger, and it was a big merger. It was a $12.6 billion merger between 2 credit unions out in California. And so this gets really interesting. It's almost like a little tabloidy here. It's really so a planned $12.6 billion merger between two major San Diego credit unions has collapsed into a bitter legal dispute, featuring allegations of disclosed compliance failures and a CEO who allegedly declared himself a dictator. Credit Union Times reported, citing a sworn court statement, the merger between California Coastal Credit Union and San Diego County Credit Union fell apart after San Diego Credit Union claimed it discovered worrisome lack of controls and outright non-compliance at CalCoast during the integration process, the report said. The conflict came to a head when CalCoast CEO Todd Lane allegedly berated a San Diego executive, stating, "I run a dictatorship and I am the dictator. I do not care what you say or what you think." According to the report, CalCoast reportedly denies the allegations, calling them manufactured excuses and untethered to any actual violations of the law. Now, fast forward to this week. So the National Credit Union Administration, the NCUA, intervened in the troubled $13 billion merger between the two credit unions. Reportedly, San Diego County Credit Union reportedly terminated the deal in November of 2025, citing non-compliance issues at CalCoast. NCUA has confirmed the merger cannot proceed as originally conceived, while CalCoast Credit Union maintains the deal is only temporarily paused pending litigation. February 20th court hearing is scheduled on California Coast CU's motion for a preliminary injunction. So here's what I find really interesting. I find the CEO's comments here really fascinating. I run a dictatorship and I am the dictator. I do not care what you say or what you think. I had to digest that for a little bit because I have worked for a number of CEOs in my career, and I would tell you that not all of them, but a lot of them do in fact think this way. they do. And they would never say it publicly. They would never allow that to be recorded. But yes, I do believe a lot of them feel that yes, they do run a dictatorship and they are the dictator. And they do not care what most people have to say. This I do believe this to be true. A lot of people would, oh, that's shocking. You can't. No, that's not right. I hear from my CEO all the time. It's all about making people feel good and culture and all the other jazz. It's like, yeah, of course you're going to hear that. They're not going to say things like that in open public forums. That's just never going to happen, But like I said, I had to laugh at that because I think that I think many CEOs would never admit, they would take that to the grave, man. They would never admit to that, or would never admit to thinking that way. But again, I think that if a lot of them were being honest or true, that yeah, that's not too far off from a lot of CEOs out there. So again, I just thought that story was interesting. Just wanted to bring that one to everybody. So, okay. Obviously, this being Valentine's Day. So the CFTC warns of relationship investment scams around Valentine's Day. The Commodity Futures Trading Commission warned consumers that Valentine's Day is an opportunity for criminals to use relationship investment scams, a form of fraud that costs Americans an estimated $10 billion each year. So the CFTC's Dating or Defrauding Awareness campaign is kicking in. So think about that for a second. The FTC warns consumers about romance scams. So with Valentine's Day approaching, the Federal Trade Commission issued a consumer alert on romance scams. The FTC said romance scams have become more difficult to detect, with scammers asking their victims for money in ways that make it hard to get back, including via cryptocurrency transactions. So again, if anybody that you meet online is asking you to start transferring cryptocurrency or wiring money anywhere, best stay away from that. So, okay. All right. So the KC Fed, the ag real estate values remain firm. So despite softer farm finances, the value of cropland in the Kansas City Federal Reserve District was nearly unchanged from a year ago. Agencies release mega bank stress test scenarios. Existing home sales drop in January. Let's see here. Mortgage applications edged down a little bit. Assets held by CDFIs declined over the past 2 years. So after growing by nearly 10 times between 2011 and 2024, assets held by community development financial institutions declined modestly between the fourth quarter of 2023 and the second quarter of 2025. The OFAC launches voluntary self-disclosure portal. It's kind of interesting. So the Treasury Department's Office of Foreign Assets Control launched an online voluntary self-disclosure portal that provides a secure method for submitting voluntary self-disclosures of potential violations of OFAC-administered sanctions programs. So that's kind of interesting. Small business optimism dips in January. Like I said, retail sales right. So this is kind of weird. I had the article earlier that said retail sales, were down surprisingly in December, but yet I got another report that said retail sales rose in December. So business inventories up in November. New York Fed household debt rises in the fourth quarter. So the Federal Reserve Bank of New York reported that total household debt increased by 191 billion or 1% in the fourth quarter to 18.8 trillion. So there you go. USDA forecasts a decline in farm income. Consumer credit was up in 2025, the fourth quarter and December. Consumer sentiment up slightly in early February. ICBA advocated that the USDA Express Loan Act introduced in the House. So Reps Brad Finstrid and Adam Gray introduced ICBA advocated legislation to speed up approval times for USDA loans. So that would be a good thing. FDIC extends comment period on stablecoin rules. This is interesting. So the FDIC issued an ICBA advocated extension of the comments period for its proposed rulemaking on the Genesis Act. ICBA also attended another White House meeting on digital asset market structure priorities. So ICBA attended a second White House meeting focused on the debate over pending digital asset market structure legislation. So this argument over stablecoins and how crypto is going to be regulated, hitting just a real wall here, if you will, in the last couple of weeks as the banking lobby and the crypto lobby are both getting very entrenched on these things. And what's at the heart of it is, banks don't want to lose deposits per se to stable coins if they come in. And the crypto crowd, they want stable coins to have rewards or some type of interest paid on it. So I'm hoping that they can kind of meet somewhere in the middle on that. But right now, both sides are really dug in. And that's why you're seeing this this continual White House meetings, and now we're seeing an extension to the comments period for the Genius Act. Now, and I want everybody to keep in mind the Genius Act that's already been passed, that's already been signed into law. They're just arguing about the finer points of how the Genius Act is going to work. Now, the Clarity Act, that act was passed by the House and is now in the Senate, and that is the big one that everybody's really arguing over, is the Clarity Act right now. I mean, basically, yeah, they're looking at the nuts and bolts of the Genius Act, but the Clarity Act, that's the primary bill that is that's being argued about in there. So, but okay. House passes ICBA supported regulatory relief bill. The House of Representatives overwhelmingly passed the Housing for the 21st Century Act, which is H.R. 6644, which includes ICBA advocated community bank regulatory reforms and promotes housing affordability. The bill, which passed 390 to 90, would allow community banks to hold custodial deposits and more reciprocal deposits without them being considered brokered deposits, provide an 18-month exam cycle and other exam relief for banks with up to $6 billion in assets, promote the formation of de novo community banks by streamlining the application process, create a 2-year pilot program to promote the creation of de novo banks, especially in rural areas, and establish a Treasury financial agent program enabling partnerships between minority deposit institutions, rural community banks, and other financial institutions. So a lot of really good things for banks in that bill. Then we have ICBA supported Trust Act introduced in the Senate. So the ICBA expressed strong support for the bipartisan Senate introduction of ICBA advocated legislation to provide expanded community bank examination relief. So we will see what comes about with that. The ICBA, the OCC should withdraw the National Trust Bank chartering proposal. So I've talked a lot about bank chartering in the last couple of weeks. So ICBA urged the OCC to withdraw its notice of proposed rulemaking on national bank chartering or issue an amended proposal that is consistent with its statutory authority. So Washington Credit Union continues to make the news. So Washington State's recently enacted tax on credit unions that acquire banks continues to make the news. I reported on that last week. Credit union tax status hasn't kept up with changing industries. So a new community banker op-ed says credit unions have changed and are abusing their tax advantage to acquire tax-paying community banks. Fed's Waller recognizes concerns over skinny master accounts. So the Federal Reserve Governor, Christopher Waller, said he's hearing concerns from banks and crypto-focused firms on his efforts to authorize skinny master accounts, but the Fed still plans to finalize them this year. ICBA expresses concern about the skinny master accounts. Yeah, I talked about that. ICBA pushes for more economic assistance to farmers. ICBA urged Congress to pass an additional farm economic assistance package. And then finally, ICBA farm groups urge no cuts to crop insurance. So ICBA and 60 farm groups opposed cuts to crop insurance during the budget process. So there is that. And then finally on this front, I wanted to read everybody. I thought this blog post was really interesting here. So this came from Naomi Snyder, editor-in-chief over at Bank Director. And the blog for this week was basically called Worse Than a Crime. So this was kind of interesting. So the closing of Bank Director's Acquire or Be Acquired conference in Phoenix Tuesday took a decidedly political bent, with a former Federal Reserve official under the first term of President Donald Trump sharing a sharp critique of the president. The criminal investigation of Fed Chairman Jeremy Powell is obviously beyond the pale, said Randall Quarles, who served as vice chairman of supervision from 2017 to 2021. That was during the last session of Bank Directors' annual conference, which drew about 2,100 attendees this year. Trump has repeatedly criticized Powell because he believes the Fed hasn't lowered interest rates fast enough. Powell announced January 11th that he was under criminal investigation for his testimony before Congress about cost overruns for renovations at the Federal Reserve offices in Washington, D.C. Powell said the move was unprecedented and a pretext to pressure the Fed to reduce rates. The president has said he didn't know anything about the criminal investigation, according to the news reports. Quarles said he voted for Trump and agreed with him on some policy matters. He also noted that he thought Trump's Fed chair nominee, Kevin Warsh, would do an excellent job. But he emphasized that it was important for people in both parties to see that criminal investigations in such matters are not just useless, but counterproductive. He borrowed a quotation referencing Napoleon's unjust execution of a duke in the 19th century. This was worse than a crime. It was a blunder. While critiquing the criminal subpoena, Quarles defended the president's right to make his views known on interest rates, emphasizing that it's only in recent history where presidents backed off public pronouncements about interest rates. Quarles referenced advice former U.S. Treasury Secretary Robert Rubin gave then President Bill Clinton, cautioning him that pressuring the Fed on monetary policy would backfire politically. Quarles pointed out that decisions are made not by the federal chairman or the president, but by the board of governors of the Federal Reserve System and the Federal Open Markets Committee, with input from Fed governors across the country. But what is important is that no one person, not the president, not anyone in Congress, not the chairman of the Fed, the president of New York Fed, can direct the short-term decisions, particularly with respect to monetary policy, that are coming out of the system, he said. I thought those comments and remarks from Mr. Quarles were very interesting. He absolutely tried to, play, kind of go right down both sides of the fence there by saying that, hey, Trump has a right to his opinion. He has a right to say that interest rates should come down. But, he can't go after Jeremy Powell. He shouldn't go after him criminally. And the comment that he made to basically say that is, what did he say? That it was useless. Where did he say that? Basically, how did I lose this and can't find it now? But basically he said it was, that this is basically it's useless. He shouldn't be doing this. It doesn't matter, whatever. In this instance, I don't agree with that at all. I don't agree with that at all. You're not, and I've pointed this out in past live streams and past episodes. Jeremy Powell, you have to put into context what they're doing over there. Like the Las Vegas Raiders just built a stadium for $2.3 billion. The LA Rams and the LA Chargers jointly built a stadium for like $2.3 billion. The Cowboys built a stadium for these are massive football stadiums that fit 60, 70, 80,000 people. The Fed is renovating a couple of small buildings in DC, and they're spending $2.5 billion on these little buildings. You have to look at that in context and scratch your head and go, what in the world is going on here? And I think the opulence and the lavishness of what they're doing is so far like beyond the scope of what the Federal Reserve should be doing over there. It's like I'm sorry, do you got like royalty coming? You hosting the Crown Prince from Saudi Arabia? You hosting the King of England? Like what? Like who exactly are you hosting there at the Fed building that you need these insane upgrades to the building at these ridiculous costs? So I do think that this stuff should be looked at. I do think that there should be an investigation of this. I don't think that this is something that should be, something that should be just arbitrarily dismissed. I just don't. I don't think that at all. So, so again, it was just interesting comments from Mr. Quarles. So I just wanted to, like I said, I wanted to read that to it. Wanted to point that out. I don't disagree with some of his comments, but also I'll just end with this on this point on this. At the end there, he basically tries to say that like, oh, hey, the Fed, it's not the president, it's not the Fed president, no individual person, makes those decisions, whatever, blah, blah, blah. I don't agree with that. I don't agree with that at all, because I think that, and one of the things I have talked about for over a year now, and again, this goes back to the Lords of Easy Money, when you talk about dissenting opinion. For many, many years, we had not, Thomas Honig, shout out to Dr. Thomas Honig. He was the true counter vote. He was the dissenting opinion back in 2010, 2011, before they booted him out of there. And after that period of time, we really had no dissenting opinion for 15 years. It just went, basically, and it has been well known that all of the Fed chairs, whether you're talking about Bernanke or Yellen or Powell, that they don't like dissent. They do not like dissenting opinions. They want unity. And basically, if you do become that bad apple, if you do become that dissenting vote, you're kind of persona non grata. You're booted out of there pretty quick. So not so like I said, but this kind of, and again, it's a very gray area. I guess you could say it like that, in some sense that, yeah, there's a lot of truth to what he's saying, but there's also, no, it's not as black and white, if you will, as that. There's large shades of gray in that conversation, in his quotes there. So, all right. So let me get back here let's get back to some banking numbers here. I wanted to show this to everybody here, and hopefully I'm making this big enough so everybody can see this. So now this is for community banks. This is looking at community bank performance. I wanted to point these out to everybody just to kind of show everybody like where are things at right now. So this chart here looks at a couple of main things. It looks at efficiency ratio, net interest margin, return on assets, return on equity, and year over year earnings change. So we have 2024 actual. The A here is for actual, 2024 actual, 2025. T3 actual. What does that mean? They're representing data through the first 9 months of 2025. And then we have baseline credit scenarios. So we have 2025 projected, 2026 projected, 2027 projected, and then we also get stable credit scenarios as well. But we're just going to focus on this first one here, this 2025 T3A, which are the actual numbers. So we can see like efficiency ratio is at 60.93. That's good. Like that's good. So basically where you want community banks to be is basically between 60 and 65%. That's like the magic number there. Larger banks, like the biggest banks out there, they might have numbers more in the 50 to 55% on average. But for community banks, you want that number to be right where it is, right in that 60 to 65% range. That's pretty good. Net interest margin, again, 3.69%. That, again, very good. That's right where anything, generally good would be like, 2.5 to 3% would be good or solid. 3% and above is really good. Outstanding, like 4% or above would be outstanding. So 3.69% is really good. Like that's good. That's solid. Return on assets at 1.24. So 1% is kind of the industry standard. So anything above 1% is really good. So 1.24, really strong. Return on equity, basically, again, industry standard there being 10%. So you're at 11.71. So again, really good on return on equity. And you can see year over year earnings change, 23.6% change in year over year earnings. So again, really looks like 2025 turning out to be a very good year for community banks. So I just wanted to point that out. And then I wanted to show everybody this real quick. So I just did an episode on bank charters, the number of bank charters that have been, we've seen this big acceleration in charters. And so this article just came out yesterday. Bank charter approvals jump in January as applications continue to pile up. So the wave of bank charter applications continues to increase, and a swell of approvals is also starting to form. So 4 bank charter applications were filed during January, putting the year on pace to an early stage to surpass the 33 applications filed in 2025. The number of applications in 2025 exceeded the total from the previous 2 years combined. So we see this chart here. So in the green, we have bank charter applications filed, and then the orange represents the applications withdrawn. So you can see here in 2025, we had 33 bank charter applications filed and only 2 withdrawn. So that means 31 are proceeding forward. And we've already got 4 so far this year, with undoubtedly a lot more coming. So like I said, just wanted to report on this. Because I do think that this is going to be a big thing to follow throughout the rest of the year. Because again, it's not just the banks that are filing for these charters, it's also the types. Like, we're seeing a lot of crypto companies. You're seeing a lot of digital companies. You're seeing like PayPal wants a bank charter. Ford and GM wanted to get bank charters. A lot of, like I said, a lot of crypto firms. So a lot of different types of companies, not just traditional banks. It's a lot of different types of companies really want to jump into the mix here and get a bank charter. So like I said, I think this is going to be a really big thing, carrying out through the rest of this year. It was a big thing last year. It'll be a big thing going throughout the rest of 2026. So, and in that vein, we have Erebor Bank receives a national bank charter. So the bank, founded by tech billionaire Palmer Luckey and backed by Peter Thiel, is the first recipient of a national bank charter under the current presidential administration. So I did a whole episode called "The Rise of Erebor." If anybody wants to go check that out, where I give the whole background on this bank and what was happening with it. Again, interesting story. They're basically trying to replace Silicon Valley Bank. Like that's kind of the customer that they're looking to go after here, because they see an opening in the market. They see an opening there. That's why Peter Thiel is all over this. That's why Palmer Luckey is all over this. And then, Erebor, for anybody who doesn't know, any Lord of the Rings fans out there. So if you saw the what was the last The Hobbit? If you saw the Hobbit trilogy, you would know that the dwarfs, their mountain where they kept all their gold, all their jewelry and their gold and everything was called Erebor. That's where the name comes from. So if you're just curious about that. So all right, but let's continue on here. So I did want to note this. So freight data indicates early U.S. industrial rebound as the Midwest truck volumes jump. So analysts say freight activity tends to turn around ahead of broader industrial indicators as manufacturers move inputs and finished goods before investment in hiring. So again, this is a very good sign that basically we're seeing that Midwest truck volumes continue to jump up, which is great. That's what we absolutely love to see there. And then moving on. So this is really interesting. And I just wanted to point this out. So Trump has this meeting coming up with Latin American leaders ahead of his China trip. So the Trump administration has worked to reestablish U.S. leadership in the Western Hemisphere, where China has built significant influence. So Donald Trump has invited Latin American leaders to a summit in Miami on March 7th. The White House official confirmed to the Epoch Times. The expected attendees are yet to be announced. However, it was a lot. I believe it was a lot of the presidents, obviously like Brazil, who else we got there? Ecuador, Argentina, a whole bunch of countries from South America there. And, again, it really looks like President Trump is really pushing in on what we call the Monroe Doctrine, which was basically hemispheric domination, Western hemispheric domination. In other words, dominate everything from the north to the south. This is our hemisphere. This is kind of our side of the world, and we're gonna take care of business there. And you see that with what he just did with Venezuela, what he's doing with the pressure that he's putting on Cuba right now. So again, just wanted to mention this, just wanted to put it out there. I think this is something really interesting. I think there could be some really interesting developments from this. And we'll see what happens. But like I said, just thought it was something interesting to point out. Trump trade advisor Peter Navarro says that the USMCA has significant flaws. So the White House trade advisor Peter Navarro says that there are significant issues with the United States-Mexico-Canada agreement, which is also known as the USMCA. But he stopped short of suggesting U.S. President Donald Trump wants to scrap the deal. I could tell you this, that USMCA has some significant flaws in it, and it's going to be reevaluated in July, Navarro said during a February 12th interview with Bloomberg Radio. Navarro also asked about media reports citing anonymous sources that said Trump had inquired of his aides about fully withdrawing from the USMCA, the trade deal he negotiated during his first term to replace the North American Free Trade Agreement, NAFTA. Navarro did not answer the question directly, but replied that nothing ever happens in the White House without the input of Trump, particularly when it comes to trade. So Navarro added that Mexico and to an extent Canada are being used as staging areas for China, Japan, South Korea, and Europe to access American markets tariff-free. They leveraged NAFTA and now use USMCA to get into our markets in a way which essentially is tariff avoidance at best and tariff evasion at worst, he said. So again, so that will be really interesting to see what what happens with that. Now, before I move on, just a couple of other trade things I wanted to note here. So the House did vote this week to override Trump's Canada tariffs. However, my belief is that Trump will actually veto that bill. I think that will happen, but we'll keep an eye on that. Tariff revenue soared to more than 300% as the U.S. awaits the Supreme Court decision. So tariff collections surged in January, with the U.S. collecting some $30 billion in customs duties. This put year-to-date tally at $124 billion, up 304% from the same period in 2025. Trump's tariffs leave importers with record-breaking $3.5 billion U.S. customs bond funding shortfall. So President Donald Trump's tariffs have led to a surge in revenue for the government, but also a record-breaking financial shortfall among importers required to buy special bonds to guarantee payments of trade duties. So yes, so like I said, remember earlier in the evening when I had kind of alluded to this, when I basically said that, hey, it's not perfect. There are some problems. Well, this is one of the problems. This customs bond funding shortfall. That will be an issue at some point that will have to be addressed. Tariff bills also across U.S. states mount as affordability and Trump head for midterm elections showdown. So data shows that from March of 2025, when the Trump administration began implementing wide-ranging tariffs through last November, tariff bills paid across U.S. states reached over the 200 billion mark collectively, and top states in 2026 midterm election races paid over 134 billion. However, I think there's a big but there with that. I think you got to look at what states. Okay, I think California, New York, it's definitely very uneven there. So, but all right, and that's okay. So that's all I got there on the tariff news. So let's move to some other stuff here. So, again, I got a couple articles here that I just wanted to point out to everybody. So I did an episode that people really loved, and that was called "Why Are Businesses Fleeing Democratic-Run Cities?" And I was a little. I'll be honest. I was a little apprehensive about putting this out because I didn't want to be overtly political. I was not trying to make it a total political hot button, if you will. But I just felt that as I do my thing every week and I pile up articles and I put together like, okay, what are people going to find? You put a lot of thought and emphasis into what is going to be helpful, but what are people also going to find really interesting? And there is no doubt there is this massive trend of people. There's a massive demographic shift in people leaving liberal states like Connecticut, New York, New Jersey, California, Illinois, and they're moving into Republican states. It's what happened. You're seeing businesses. Now, I saw this week. New York mayor urges state lawmakers to pass tax hikes on the wealthy corporations. Zohan Mandani says a 2% surcharge on millionaires could help close the city's deficit. Now, I want you to keep this in mind because this is always what happens. What did he campaign on? He campaigned on a billionaire's tax with a B. He didn't talk about millionaires. He talked about a billionaire's tax. Okay. Now all of a sudden it's oh, well, hey, let's go after millionaires because millionaires, they got they're rich or whatever. I will tell anybody, if you've got $1 million or $2 million, the bulk of that money is probably in like your 401k. That's not like liquid cash that you've got just lying around. Like, oh, hey, let's get the private jet this weekend and go jettison off to the Bahamas. You know what I mean? No, that doesn't, to me, in my mind, like that doesn't make you rich. If you've got $1 million in disposable income, like in other words, you've already got 5 million sitting in a retirement account and you're making $800,000 a year and you've got $1 million that you can literally just blow on anything you want. Now, okay, you could be considered rich in that context. But all I'm saying is that this is where it always goes. This is the same crap that you see out of politicians all the time. They always start out with, oh, we're going to go after the big guys. And then it automatically always ends up being the little guy that gets the brunt of the taxes. It never fails. It never fails. But let me show you some of the repercussions here of this. So California billionaire tax will be disastrous and cause wealthy to flee, economists predict. Supporters of the 2026 California billionaire tax call it an emergency fix to prevent a healthcare collapse. So in California, they have positioned this billionaire's tax as basically like, oh, this is what is going to bail out the healthcare system in California. No, that's not going to work. It's not going to work out the way that they think. And why is that? Well, let's look at this. Mark Zuckerberg becomes the latest California billionaire to relocate to Florida amid tax concerns. So the Meta CEO joins Bezos, Brady, and other ultra-wealthy neighbors on Indian Creek as California pushes the 5% wealth tax. So now you're seeing all these guys flee and scurry. They are going to leave. Now, you will hear a lot of the lawmakers in these states, I've already heard this said many times. You will hear them say things like, oh, well, we will go after them. We don't care if they leave the state. We'll still go after them. Hello, what you don't understand is that Mark Zuckerberg has an army An army, not a couple. He's got an army of the finest accountants and lawyers that money can buy. Do you think that he would hesitate for a minute to sick them on the state? And who do you think's going to win that? I get that in a certain respect, the state has unlimited resources in a sense, but so does he to a very real extent. So I don't see them winning that battle in court. I see some of these billionaires easily winning that battle in court and basically giving the bird, as it were, to these states and saying, ha ha, yeah, laughing as they walk out the door. So again, this kind of stuff, it's only going to drive this trend. It's only going to drive this trend further. Again, the more that Democrat policies in these cities are to increase taxes, increase regulation, making it more difficult for businesses to run, they're just going to force these people out. That's what's going to happen. And you're not going to get the taxes that you think that you're going to get. That's just a reality. That's just a reality of what's going to happen. So now let's talk about this Minnesota fraud here for a second. Gosh, this really stupid, annoying commercial, right? I should love this thing. But anyway, Philadelphia men repeatedly traveled to Minnesota to carry out $3.5 million housing fraud scheme, according to the DOJ. Defendants allegedly used AI to fabricate records and marketed themselves as the housing guys at homeless shelters. I mean, these guys were so horrible. They left my area of Pennsylvania, Philadelphia, Philly area, and went and literally drove up to Minneapolis because they knew it was going to be easier for them to perpetrate this fraud up there in Minneapolis. This is disgusting. And this was another episode that I did a few weeks back where I basically said that I was worried that this was going to metastasize. This was going to spread like wildfire across the country. And I warned banks. I said, banks better be watching their P's and Q's for customers and the people using their accounts and what's going on there, because this is going to come back to bite them. Now, let me show you something else here. How a $30 billion welfare program became a slush fund for states. Republicans and Democrats alike decry the lack of oversight for America's famous anti-poverty experiment, fraud by design. So when the Trump administration targeted billions of dollars in federal welfare funds recently over fraud concerns, it singled out 5 Democratic-run states. An examination by the Wall Street Journal found that the main federal aid program the administration is seeking to block, Temporary Assistance for Needy Families, or TANF, TANF, has long been plagued by poor financial oversight and questionable spending in states led by both Republicans and Democrats. Auditors in numerous states, including Connecticut, Louisiana, and Florida, have uncovered problems with TANF. Once America's primary welfare program for low-income families, created 3 decades ago, it comprises more than $30 billion. So again, this is just the point that I'm trying to make. Like this fraud, there is no doubt. And I think the number is probably massive. I think you're talking about the trillions of dollars of fraud in all of these in these social welfare programs, the welfare state, there is no doubt that the fraud is just off the charts. And this is going to move into, I think, a number of different areas, and it's going to move into a lot of states. And I think that and the reason why I point this out, again, it's not to be political, it's to point out that this will in fact come back to there are a number of banks out there. This could be in the hundreds of banks around the country. They're going to get caught up in this in some way, shape, or form. They're going to, and they're going to get penalized. They're going to have problems. I truly believe that. And that's why I just said, I put that warning out there that I think a lot of banks really need to mind their P's and Q's on this in the months and the year ahead. So that's all. That's my statement on that. So, all right. Let's get into another interesting and juicy topic here for a minute, shall we? So, the Epstein files have just blown up, and they have blown up people in the finance, banking, Wall Street world. Has been unbelievable. So I'm going to run through a series of articles here with everybody real quick. So Judge Blind eye accusations sufficient in Bank of America's Epstein case. So a bank spokesman reiterated Thursday that the lender looks forward to a full review of the facts. So what's happening here? So claims of Bank of America's reckless disregard of information on Jeffrey Epstein's sex trafficking met the bar for an alleged victim's lawsuit to move forward, a federal judge said Wednesday. The opinion and order detailed U.S. District Court Judge Jeff Rakoff's January 29 dismissal of 4 claims against B of A and all claims against BNY made by Jane Doe. Rakoff, however, allowed 2 claims against Charlotte, North Carolina-based Bank of America to proceed. Accusations the bank was a knowing beneficiary in a sex trafficking venture and that it obstructed the federal government's enforcement of trafficking laws. This Wednesday opinion, which didn't determine the merit of the 2 remaining claims against B of A, said an amended complaint plausibly asserts that the bank turned a blind eye to these repeated, detailed allegations, some emanating from police reports widely circulated in the press, but utterly failing to engage in due diligence about them. So again, pretty bad there. So we'll keep an eye on this one. But I wanted to point out this so that this defendant has this case against Bank of America. They had this against BNY as well, but the charges against BNY have basically been put out, and now it's just these last 2 charges against Bank of America here. So we'll keep an eye on what happens with this. Now, I said this last week, Goldman Sachs' top lawyer to step down following the latest Epstein documents. Bank had been steadfast in its support of Catherine Rumler. Recent documents showed she was a close ally of Epstein's through his 2019 arrest. So, and again, I gave people a little bit of background on Mrs. Rumler here last week. So Mrs. Rumler, basically, I want people to understand who she is and what she is. So she was the main attorney in the Obama White House. She was Obama's fixer. That is well known. Everybody knows that. There's no secret there. She then ends up over here at Goldman Sachs, obviously because of a lot of her political connections that she has. But she was thick as thieves with Epstein. And when Epstein got arrested in 2008, okay, who was his first phone call? Boom. Hey, Kathy, can you come over here and help me out? So this has been obviously a battle behind the scenes for a while, but I knew this was coming. I knew that this was coming. I knew that the evidence that came out against her was so damning that there was no way that she was surviving this. And then I point this out. So this came out today. This was today's article. How Kathy Rumler and Goldman Sachs finally reached their breaking point. Unease among some board members grew following the latest document releases and the resignation of Paul Weisses as chairman. Now, Paul Weisses, he's with another firm. But Goldman Sachs chief executive David Solomon for months staunchly defended his general counselor, Kathy Rumler, in the midst of a storm over her ties to Jeffrey Epstein. Solomon said he had complete confidence in Rumler, a key advisor of his and former White House counsel for President Barack Obama. Really? Despite revelations about her past connections to the infamous sex offender. Her future at the firm seems secure. Then the winds changed. A new trove of documents showed Rumler and Epstein discussing his legal and media strategies over email, which people familiar with the matter said raised concerns among some of Goldman's board members. Like, in other words, they were like everybody else. They were on X. They're on X blowing through going, oh my gosh, look at this. Like, yeah. So, they're all looking at that. They obviously, I'm sure there was a lot of this. I said that last week. I'm sure I said there is undoubtedly a lot of discussion behind the scenes. But then there were other things that happened this week. Separately, Brad Karp, who was the chairman of law firm Paul Weiss, he stepped down from his position on February 4th, urged by his partners, who said he couldn't continue after other emails suggested he had been closer to Epstein than previously known. Some Goldman board members viewed Karp's situation as somewhat parallel to what the bank was facing with Rumler and wondered about the optics of her remaining at the firm. The people familiar with the matter said some of Goldman's clients were asking questions too. Yes, I'm sure there was a lot of people that called up and said, are you kidding me? Why is this person working for your firm? Then let's look at this. So then we had the whole thing with Howard Lutnick. where, Howard basically sits there and goes, "Oh, hey, I didn't know Epstein. I didn't talk to him, even though he was my neighbor for 10 years." But then it was like, "Oh, well, I might have popped over to his house one time." And then it was, "Oh, well, yeah, I did go to the island, but it was just that one time with my family." So I think Howard is going to be the next guy to go here, because I don't see how he can't. I mean, he's obviously lied about a lot of his connections here repeatedly. So I don't think he's going to be able to hang on much longer. We also have this. Casey Wasserman is putting his talent agency up for sale after the Epstein fallout. So Wasserman has said he never had a personal or business relationship with Jeffrey Epstein and told staff he felt that he had become a distraction to the firm's work. Yeah, not so much, Casey. So Casey is basically putting up his agency for sale and basically getting out of here. So, yeah, no doubt. And then we also have Dubai's DB World replaces CEO after Epstein links emerge. So Dubai's DB World announces Essa Kazim was the new chairman of its board of directors, and Yaraz Narayan was its new group chief executive officer, replacing Sultan Ahmad bin Salem. Salem had been the CEO of Dubai's largest port operator since 2016 and chairman since 2007. GOJ records showed years of exchanges with Epstein, but Salem has not been accused of any criminal wrongdoing. So this gentleman is out. So the fallout. And then we go into Epstein's Silicon Valley connections went beyond Gates and Musk. Newly released records detail Epstein's contacts with top U.S. technology executives. Reid Hoffman, anyone? Authorities stress inclusion in the files is not evidence of wrongdoing. Documents shed light on Epstein's influence building before his death in 2019. So, and I would also tell you, too, that there have been major developments in Europe, not just with Dubai, but also in England, with Prince Andrew, with this princess. I think it was in the Netherlands, but then there was another gentleman in the Netherlands has actually gotten criminally charged with what happened with Epstein. So you just again, and what is all this show us? What is all this telling us now? Well, the conspiracy theories have all been born true, and this is my estimate is this is going to get far worse before it gets better, and this is just the beginning. This is just the beginning of this fallout, and you are going to see a lot more people get nailed into this. I would not be surprised. And how there cannot be, I'm just going to say this last piece, how there could not be more criminal indictments here it's beyond me. It is absolutely beyond me. There's a lot of people here that need to go to jail. A lot of people, a lot of powerful people, a lot of and now we also see here why this was kept under wraps for as long as it was, because you literally have some of the most powerful and influential people in the world wrapped up in this. And which we all knew. That's not a surprise. So again, I wanted to point this out because there's just a lot of fallout here, and we'll continue to watch this. But as I predicted, like I said, just wanted to show that Kathy here, yeah, she didn't last long. I said this last week that she was going to be gone, and sure enough, this week she's out. So that is as they say. So all right. Let's get into, just wanted to touch on this. I got a couple more things here, and then we're going to wrap up for the night. So a couple more articles to go through here. So Detroit automakers take a $50 billion hit as the EV bubble bursts. Companies are taking big losses and making moves to reduce electric vehicle capacity amid regulatory changes and cooling demand. So obviously the EV tax credits expired, and we saw all kinds, I don't know that anybody was not touched by this. General Motors took a hit, Ford took a hit, Stellantis took a hit, Tesla took a hit. Everybody took a hit here. You can see here this chart, net profits lost semi-annually. General Motors, down not as much. Ford down. Stellantis took a huge shot. I think they took like a $26 billion write-off here on EVs. So just Pretty ugly. We did get this warning on tech stocks here. So basically, UBS on Tuesday downgraded the U.S. tech sector to neutral to persistent concerns about AI-driven disruption in the software industry and an expected slowdown in AI infrastructure spending. Jefferies analyst in a recent note identified slower AI spending as a potential catalyst for a rebound in software stocks after last week's SAS apocalypse, the supocalypse, whatever you want to say. So yeah, just interesting. I just wanted to point this out. I saw this that UBS had put through this downgrade, and I just wanted to, like I said, just wanted to bring it up, just wanted to discuss it. The big trade on Wall Street, if you will, forget the sell America trade. Now here comes the hedge America trade. Now this is the big trader. So U.S. stocks have rallied, but the dollar slide and slowing foreign purchases of treasuries are warning signs. So we'll continue to keep an eye on that. Now here's this article on graduate school that I wanted to bring out of it. So new graduate school student loan restrictions may encourage schools to lower tuition. So the Department of Education is eliminating the Grad Plus loan program starting the 2026-2027 academic year, which previously allowed graduate students to borrow enough money to pay for their entire education. The department expects the new limit on graduate student loans to lower graduate tuition costs. However, experts say the government must work to ensure lenders can offer loans to a wide range of students. So, but like I said a lot earlier tonight, what happens when you get the government out and you start to turn that spigot off a little bit? Magically, the costs will come down because they have to lower the cost to keep it affordable, because they know that if the government's not going to fund the bill 100% like they have, then they're going to have to lower their costs because the students aren't going to be able to afford to do it. So this gets back to my point of the more you get the government out, the better it will be, the more costs will come down. So, all right, let's run through. So here's some articles here on CEO pay here. I just wanted to show this real quick. So Capital One pays CEO Fairbank $40 million for 2025. The pay package represents an approximate 19% raise over the $33.5 million Fairbank, who's 75 years old, by the way, received for 2024. Don't we all wish we got a 19% raise? Just saying. Morgan Stanley pays CEO Pick $45 million for 2025. The package adds to evidence that $40 million is the emerging benchmark by which big bank CEO annual compensation is measured. And then we go here to Citi pays CEO Frazier $42 million for 2025. The bank touted progress in modernizing its tech, continuing to exit foreign retail markets and marching toward the medium-term goal of its reorganization. Just so everybody knows, Citi has been reorganizing for 25 years now. Like, this is nothing new or nothing shocking. So it's like, and they will continue to be reorganized. I guarantee you 30 years from now, they'll still be reorganizing. But I just wanted to show you this pattern that now that, like, again, as we looked at in this other article here, the package adds to the evidence that 40 million is the emerging benchmark. This is the new hot number now. 40 million is the new number here for pay among these big Wall Street firms, which is, again, it's astronomical. So, all right. JP Morgan and Nacha to share data via blockchain. So the companies aim to simplify the account verification process for JP Morgan Chase customers. So this is really interesting. I want to keep an eye on this. I will, like I said, I'm sure there's going to be more to come with this, and I will bring everybody more information on this as we get later into the future. The Fed skinny account idea draws criticism. I had mentioned this a little bit earlier. A prototype payment account carries undue restrictions, fintech groups said in response to a Fed proposal that offers expanded real-time payments access. So again, this kind of fight over access to the Fed and the Fed skinny account continues to roll on. So Holdco drops KeyBank and Eastern Bank proxy fights. So the investor expressed renewed confidence in KeyBank CEO Chris Gorman after he clarified the bank's no acquisition stance, and the lender replaced its lead independent director and 2 board members. So yeah, so Holdco has been, I talked about as an activist investor, I've been following them for the last few months. I mean, they've been running around, kind of jumping on a whole bunch of banks, and a lot of the stuff that they've been going after just seemed like it's going nowhere. So like I said, just wanted to mention this real quick. Let's see here. U.S. banks wrestle with regulation amid rising AI spending. So despite the challenges, financial services firms in the U.S. lead their global counterparts in AI maturity, according to a Finastra report. So again, no shock here, but we'll continue to keep an eye on that one. Mr. Beast acquires a youth-focused fintech step. Nobody taught me about investing, building credit, or managing money when I was growing up, the YouTube star said on X. I want to give millions of young people the financial foundation I never had. I don't trust this dude. I don't like this dude. There's something in the eyes, something in the face. Like this dude is like got the fakest smile of all time. Like there's something about this dude that has always bothered me. And so this, I don't know, this whole thing here, him getting into this, buying this banking app step, yeah, I don't know. It just rubs me the wrong way. I don't know, whatever, but that's what I got. So all right, that's what I've got for everybody tonight. So I'm going to go into wrap up mode here real quick. So let me get some different stuff up. So first I want to, before I get to my story of the week and my quote of the week, items that I touch on at the end of every live stream. So if you are on Apple Podcast or Spotify, please leave me a review. That would really help the podcast, really helps the channel. I just ask every week if you can leave me a positive review. That really helps. I really appreciate it. Where are my banners? Hold on, where are my banners here? All right, so if you could visit thebankernextdoor.com, got a lot of interesting stuff up there. Obviously, all the episodes, live stream, and all my regular episodes are all posted up there on the website. Everything is archived up there, so you can go in, you could search for specific topics, you can look anything up, blog posts, market data information, a whole bunch of stuff up there on the website. So please check that out when you have time. Make sure to subscribe on YouTube to get all the latest posts. Like tonight was a perfect example. I had to start. I usually start at 8 o'clock. I had to start at 8:30. Got a little behind, but I put out a post real quick about an hour beforehand, basically just saying, "Hey everybody, I'm backed up a little bit. We're going to start at 8:30." So that's a perfect example of why you should subscribe on YouTube, just so you could get all the latest and greatest posts and info that I put out. Make sure to send your comments to info@thebankernextdoor.com. So if you have any topic recommendations, anything you'd like me to cover, any questions you might have, anything like that, you can reach me at info@thebanker.com, info@thebankernextdoor.com. So make sure to hit me up on there. You can follow me on Getter, Truth Social, and X. I will tell you, I probably spend the bulk of my time on X, but you can reach me on these different social media platforms. Remember that just remember that the podcast is on Rumble, YouTube, and all major podcast platforms. I put out new episodes Monday through Friday every week at 12 noon. So, and most of the episodes are approximately 10 to 20 minutes in length. So I keep them short intentionally. So hopefully they're very easily digestible topics. And also just remember that the BND Strategy Room live stream is every Saturday night at 8 p.m. So there you have it. So now let's get into my story of the week and quote of the week. So for story of the week, last few weeks, I've been spending a lot of time on yield curve. I did a few weeks back, I did treasury yield, I did yield curve, I did yield curve control, I did inverted yield curve. So now I just want to talk about the 10-year treasury note. So let's just read the 10. So the 10-year treasury note is a debt obligation issued by the U.S. government with a maturity of 10 years upon initial issuance. A 10-year treasury note pays interest at a fixed rate once every 6 months and pays the face value to the holder at maturity. That was at the end of 10 years. The U.S. government partially funds itself by issuing 10-year Treasury notes. The yield on the 10-year U.S. Treasury note is among the most widely tracked bond market indicator in the U.S., serving as a gauge of investor confidence and as a benchmark for determining various other types of interest rates, including mortgage rates. Given the inverse relationship between bond prices and yields, a falling yield indicates greater investor demand for treasuries and vice versa. The yield on the 10-year Treasury note is often used as a proxy for other interest rates, including those on mortgages and corporate bonds. The average rate on a 30-year fixed rate mortgage, for example, has surged in tandem with yields on U.S. Treasury bonds. Not lately, but yield on both investment grade and high yield corporate bonds have also recorded a large increase over the last few years as their underlying prices have declined. But again, the point there being is that the 10-year Treasury is heavily tied into all of the consumer rates that we have, the mortgage rate, the auto loans, the credit card rates, student loan rates, everything runs in a very real way off that 10-year Treasury. So it is a very, very important thing, a metric for us all to look at and all to take us into consideration. It can, like I said, it can also tell you a lot about Treasury sales and the bond market and what's going on. So the risk factors, how people on the market, and whether it's the Wall Street or the bond market, how they feel about things are going right now at the moment. So again, 10-year Treasury, it's why this is why I spend so much time talking about the 10-year Treasury, because it's such an important metric for us to look at and to consider in a lot of things. So, all right, now let's just do our quote of the week real quick. So this comes to us from Winston Churchill. So, courage is rightly esteemed the first of human qualities because, as has been seen, it is the quality which guarantees all others. And that comes from Winston Churchill. I could not agree more. Courage is the most important thing, because anything else that we do comes from courage. Okay, any other virtues that we espouse, anything else that we the ethics, the morals that we attempt to achieve, it's all made possible through courage. So I think that is a phenomenal quote from Winston Churchill, and absolutely love it. So with that being said, I just want to thank everybody for hanging out with me for a couple hours tonight. I really appreciate it, as always. I hope everyone has a good weekend out there. Hope everyone has a great President's Day on Monday. I will have new episodes coming out this week, Monday through Friday, as usual. But like I said, just hope everybody has a great holiday weekend out there. Happy Valentine's Day again to everybody. And, be good, be safe. And I will see everyone again next weekend. Thank you. Thanks a lot.